Thank you for joining me on this video. My name is Rodney Constable. I'm the president of Simple Market Signals, and today we are going to be doing technical analysis on the S&P 500 for Monday, February 18th, 2020. First thing I want to point out is in the upper right-hand corner of the chart here, you can see we were down 0.29%, so not too bad of a day overall, but the day was a lot more volatile than what you can tell by looking at this particular chart, which, by the way, each one of these candlesticks is 1 day. So this is a 1-year chart in the S&P 500, and each day is represented by one candlestick. So let's do this. Let's move on to this chart right here, and this is what I call putting the market under the microscope. This is a 2-day chart, so this is Friday and then Monday here, the 18th, and each one of these bars, it's pretty tight here, but each one represents 1 minute of trading in the S&P 500. So the first thing I wanted to do here was show you that we gapped down. So this is where we closed on Friday, and this is where we opened today, and you can see that we opened and went slightly up, and then about 10:15, the market kind of cracked and we fell, and did kind of a double bottom here, 11:45 and then 12 o'clock noon, and then bounced up from here. So let's move on to this next chart, which is the same basically, but this is just today. So instead of having a 2-day look, which makes it pretty hard to see when you're looking at 1 minute of trading at a time, we will zoom in here, and this is today's intraday trading. Again, each one of these vertical bars, these candlesticks, represents 1 minute of trading in the S&P 500. So again, here's where we opened. We climbed slightly, and then about 10:15 here, the market fell, and we did a double bottom at 11:45 to right at 12 noon, as you can see there, and then the market started to rally and made it back up and slightly higher than where we were in the morning, and then we sold off into the afternoon. And then you can see here, literally the last minute of trading, some volume came in there, which is not unusual at the last minute for the day, kind of get all the trades in. And you can see here that we closed at 33.70.32. And if you've been watching my videos from this past week, you know how important this 33.70 area is. We will look at that on several different time frames over the next few minutes, but just understand this, it just shows how incredibly resilient this market has been, but it also shows you how important this 33.70 level is, at least in the short term. So the short-term support area is at 33.70 on the S&P 500. Now let's move on and take a look at a 5-minute 5-day chart. So each day here, so here's Monday, Friday, Thursday, Wednesday, Tuesday of last week, and so this represents, these areas right here represent each day, and each bar is a 5-minute candlestick. So each bar represents 5 minutes of trading in the S&P 500 for the last 5 days. And again, you can see here that we barely, the last 5 minutes, we barely made it back to this 33.70 area. But let's annotate this here. Let me get my annotation tool, and it just makes it a little easier to see. When we really draw the line here, we can really tell over the last 4 or 5 trading days, we went predominantly sideways Wednesday, Thursday, and Friday, kind of trading in a range of 33.70 to 33.80, that's where most of the trading was. We dipped down below that 33.70 area there on Thursday and back above it, and then really on Friday had some very tight trading, pretty much in between the 33.70 and 33.80 levels. So most of the trading there. And but here again today, you can see that we gapped down and then fell and then spent most of the day under 33.70, and then at literally the last minute, as you saw on the previous chart, we were able to climb back up and close just slightly above that 33.70 area, again closing at 33.70.29 on the S&P 500. But you can see here just how important, we kiss the 33.70 level, and traded right around that pretty heavily on Friday, and then you can see where it acted as overhead resistance, and then again got right back up, acted as somewhat of an area of support right in here, and then just barely made it back and closed above that. So again, 3370, as you can see here, is a very important short-term support area. So to the degree that we continue to close above and stay above 3370 on the S&P 500 going forward, there isn't much to worry about. However, if we start to see several days where we close beneath that 3370 area on the S&P 500, that will let us know that the markets are starting to get weak in the short term. So let me get rid of my annotation here, and let's move on to the next time frame, which this particular chart is a 60-minute chart. So each vertical candle there, each bar, each candle represents 60 minutes of trading, and this is a 2-month chart. And again, let me grab my annotation tool, and let's take a look at this 3370 area. Again, I like to look at different time frames because it really helps, especially on something like these hourly charts. You can see where we've closed, and you can really tell here for the last week or so, week to 2 weeks, where this 3370 area represented overhead resistance for a few trading hours, if you will. Again, each one of these candles represents an hour, but once we got above it, this 3370 area has acted as an area of support for the markets. So again, you can really see how important that 3370 area has been. Now, before we move on back over to the daily chart, where we're looking at an entire year, just one day at a time, let's do a little bit more annotation here and take a look at some other support and resistance levels. Because if this 3370 area doesn't hold, the next area of support is going to be somewhere around this 3220 area. And you can see here that once we cleared this back in the middle of January, that it acted as an area of support. Once the headlines came out and the fears over the coronavirus, of course, we sold off for a few days and then bounced up. And again, we've been back above this 3320 area since really the first week in February. So you can see how important this 3320 area is. So if 3370 doesn't hold, you can see that there's a little support here at 3355, but really the next level of support is probably going to be found somewhere around this 3320 area. And then if the 3320 area doesn't hold, any of you that have watched any of my past videos know that round numbers, in this case 3300, can act as support and resistance areas. There's a psychological effect with humans around these round numbers, but also it's good to look at trading ranges. So 3300 to 3320, going to be some support there. If this doesn't hold, then as you can see here, when we go down, there's going to be some support probably around this 3260 level, and the 3220, which we will spend a little bit more time on this. The 3220, I believe, for right now, is the most important support area that we have. But again, 3370, as long as we stay above it, we're golden. There's not much to worry about in these markets. A little bit of support here at 3355, 3320. Again, that'll be a nice little area that's been around for a couple months, so that could really help us out. 3300, the round level, and then you can see some support and resistance a little bit at 3260. But 3220 is the more important area. And with that said, let's move in. Now, this is a 3-month chart where each candle represents 1 day of trading. So it just allows us to kind of focus on these last 3 months. And let's get the annotation tool out here. Got a little bit of a frog in my throat today. Sorry about that, guys. And you can see here, when I draw this line at 3220, you'll see what I'm talking about. So back in December of 19, okay, once we got above this 3220 area, you can see that we have not since, let me draw a vertical bar so we can really get the day on this, since the 20th of December, okay? You can see that's the, and these bars down here, by the way, are the volume. So you can see here that we had a really nice volume spike. And again, just to kind of illustrate this point, volume matters. So if we draw a line on top of some of these volume bars, you can see most of the volume, right, has been underneath, over the last 3 months or so, has been underneath this level. When you get a big volume spike like that, especially on an up day, that is very significant. Now, it also, volume spikes on down days like this one here are also very significant, okay? But if you get a low volume up day or a low volume down day, it just doesn't matter that much. So volume matters. So once we spiked up on the volume, got above this 3220 level, you can see that we have not closed. We've traded a little bit below it a few times, kissed it right here intraday, but we have not closed below 3220 on the S&P 500 since December 20th. That is very significant, and that's why I'm saying that this 3220 level really is the area to watch. Now, we've got the blue line here, which is your 50-day moving average, and the green line, which is the 20-day moving average. So each one of these areas, and you can see the 3320, which I showed you that area of support, somewhere around in that area. It's just barely below the 20-day moving average. And then that 3260 area, which I pointed out, there was a little bit of support and resistance somewhere around there. You can see it lines up pretty nicely, kind of in that window, right, with the 50-day moving average. So all of this will come into play if the market starts to crack and if we start to fall. If this 3370 level does not hold, then you can expect, again, support at 3320, and that's the 20-day moving average. Somewhere around 3260, that's the 50-day moving average. 3220, again, that's the one to really watch. We don't want to fall beneath that, because I think if we do fall beneath that, then we're probably, heading down towards the 200-day moving average would be my guess. Now, there's other support areas. We'll take a look at that on the daily chart for the full year because it'll be easier to see. But I think you can see why I'm saying that 3220, that's really the area you need to keep your eye on. Get rid of the annotations here. We will go back over to the daily chart, and let me refresh this. And still haven't got our volume update for the day. That's fine. Let's pull up the annotation tool, and we'll stay predominantly beneath the 3220 level because we already know how important that is. So I will just go ahead and draw the line there so we know how important that is. But you can see here, and this is another thing, and any of you that have watched any of my other videos know that I've been talking about this for a few days. We're a long way away from the 200-day moving average, okay, which currently is setting, where is that setting at? 3487, okay, is where the 200 is at. I'll just kind of put this like this. So the gold line, this gold-orange line, that is the 200-day moving average, which is just above some long-term support at around 3020. And then again, the round numbers, 3,000 in this case, would come into play. So I think, if this 3220 level doesn't hold, you can see there just isn't a lot. There's some support around 3140, maybe around 3120, 3100. So there's a little bit there, but much larger area of support somewhere around this 3020 plus or minus 20 points, which again brings us down to this 200-day moving average. Now, let me run my calculator really quick to give you an idea. We should be somewhere around 11% above the 200-day moving average, which did some research over the weekend. It's not unusual for us to trade, let's see, we're 3370.29 minus 34.87, which is the 200-day moving average. We're trading at 335.42 points above the 200. We divide that by the 200-day moving average, and we come up with, get the right calculation in there. Yeah, we're 11.05% above the 200-day moving average. So it's not unusual for us to trade that far above the 200-day moving average, and it doesn't mean that a correction back to the 200 is imminent anytime soon. But that is, generally, right? I mean, these corrections here back towards the 200. Now, this is a 200 again. We never hit it here, but we did pull back to the 200 back in end of May, beginning of June of 2019, and that's the last time we have touched the 200-day moving average in the S&P 500, and we were only about 5.5%. I'd have to run the math, but we weren't that far above the 200, and we still pulled back there. And again, you can see there about 11 months ago we pulled back and kissed the 200 as well. If we start to see more weakness in the markets, if the 3370 level doesn't hold, and if we start to take out these support and resistance levels, if we take out the 20 and the 50-day, and we start to move down towards this 200-day moving average, just understand that that could be a 10% pullback. And as a reminder, a 10% pullback is considered a correction, a 20% pullback from your previous all-time high, whether it's in the stock market or an individual stock or a sector or whatever, that's considered a bear market. So a bear market is a 20% sell-off from the previous all-time high. A correction is where you pull back at least 10%. I hope you guys have enjoyed today's technical analysis of the S&P 500 for Monday, February 18th, 2020. If you haven't already done so, please subscribe to my YouTube channel. Go out there, play around, check out my other videos. I've got a lot of great educational videos out there on the stock market and some other success principles. Please give me a thumbs up on this video, leave a comment, and tell your friends and family about my YouTube channel. And I look forward to seeing you in the next video.